Welcome to the video. Today we're unpacking a counterintuitive but freeing idea about traditional IRAs and 401k rollovers. For most savers, tracking the original source of funds inside your traditional IRA is unnecessary. I'll explain when that's true, the crucial exception, and what steps to take to make sure you're not double taxed. We'll also cover state-level quirks and Roth conversions in plain English. Let's begin. First, here is our roadmap. We will start with the big idea. Then compare deductible and non-deductible contributions. Next, we will cover the Form 8606 exception and walk through how to verify your basis step by step. After that, we will address important state tax differences, discuss Roth conversions, test your understanding with quick quizzes, and end with practical takeaways. Next, let's frame the main concept. If all your contributions to your traditional IRA were deductible and pretax, your cost basis is effectively zero for federal tax purposes. Therefore, when you withdraw in retirement, the full amount, both the original contributions and the investment growth, is taxed as ordinary income. Capital gains rules do not apply inside the tax-deferred IRA wrapper. Consequently, worrying about which dollars came from which job or which 401k rollover is largely unnecessary. Moving on, here is why it's usually simple. Traditional IRAs are tax-deferred. If your contributions were deductible, you do not have federal tax basis. That means the entire retirement distribution is subject to ordinary income tax. It makes no difference which employer plan the funds came from or how the money was invested. Because of this, keeping granular records of each original dollar is unnecessary for most savers. Furthermore, let's compare the two contribution types. Deductible contributions reduce taxable income in the year you contribute and create no federal basis. Consequently, future withdrawals are fully taxable as ordinary income, and detailed source tracking is unnecessary. In contrast, non-deductible contributions are made with after-tax dollars, do not reduce taxable income, and create a basis that must be tracked on Form 8606. Later withdrawals are prorated between tax-free return of basis and taxable earnings, making accurate basis tracking essential to avoid double taxation. Now here is the crucial exception. Non-deductible contributions to a traditional IRA create a tax basis. You must report and track this basis using IRS Form 8606. When you take distributions or perform Roth conversions, the pro rata rule applies across all traditional, SEP, and simple IRAs considered together, not account by account. If you suspect you made non-deductible contributions, but do not see Form 8606 in your records, do not panic. You may be able to reconstruct the basis using prior tax returns, account statements, and tax transcripts. A quick way to verify is to look for Form 8606 in your historical returns, and check the cumulative basis lines, typically line 14, which carries forward the basis. Next, here is a step-by-step process to verify your basis. First, pull your last decade or more of tax returns and look specifically for Form 8606. Second, if you cannot locate the form, obtain IRS transcripts and review brokerage statements. Third, check whether contributions were deducted on your federal return. Fourth, if non-deductible contributions exist, identify the cumulative basis shown on the most recent Form 8606. Fifth, store this documentation with your permanent tax file so it is available when you take distributions or perform Roth conversions. Finally, if your records are incomplete, consider consulting a tax professional to reconstruct your basis. Meanwhile, this mind map organizes the core ideas. The central node is traditional IRA tax treatment. One branch covers deductible contributions, which create no federal basis and lead to fully taxable withdrawals, rendering detailed source tracking unnecessary. Another branch covers non-deductible contributions, emphasizing Form 8606, basis accumulation, and the pro rata rule across all IRAs. A third branch highlights state rules, calling out states like Massachusetts, Pennsylvania, and New Jersey that may not allow deductions at contribution time, which necessitates tracking a separate state basis for future exclusions. A fourth branch addresses Roth conversions, which can simplify taxation over time but are not required. The pro rata rule still applies if basis exists. The final branch stresses record keeping, including returns, statements, and transcripts, and notes that reconstruction is possible if documents are missing. Additionally, state rules can differ significantly from federal treatment. In Massachusetts, Pennsylvania, and New Jersey, contributions may not be deductible at the state level. This means you should track a state basis so that a portion of future withdrawals may be excluded from state income. Other states vary, so always review your state's rules and maintain documentation to substantiate any exclusion. Now, let's address Roth conversions. Converting some traditional IRA dollars to Roth can simplify future taxation by reducing or eliminating required minimum distributions and enabling tax-free growth. However, conversions are not mandatory. If you have non-deductible basis, remember that the pro rata rule applies to conversions just as it does to withdrawals. Consider conversions strategically in lower income years, and remain mindful of Medicare premium surcharges and other phase-outs that may be triggered by higher income. Next, here is a quick knowledge check. The question is, if every contribution in your traditional IRA was deductible, how are withdrawals taxed in retirement? Option A. Only the growth is taxed at capital gains rates. Option B. Only the original contributions are taxed at ordinary income rates. Option C. The entire withdrawal is taxed as ordinary income. Option D. Withdrawals are tax-free. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. If all contributions were deductible, your federal basis is zero, so both original contributions and growth are taxed as ordinary income when withdrawn. Next, another quick quiz. Which situation requires tracking with IRS Form 8606? Option A. Rolling a 401k entirely into a traditional IRA, all pre-tax. Option B. Making non-deductible contributions to a traditional IRA. Option C. Taking required minimum distributions from a traditional IRA, funded only with deductible dollars. Option D. Holding stocks in a taxable brokerage account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Non-deductible contributions create basis that must be tracked on Form 8606 to prevent double taxation and to apply the pro rata rule correctly. Before we wrap up, here are the core takeaways. If your contributions were all deductible, you can stop worrying about tracking the original dollar sources because the entire distribution is taxed as ordinary income. If you made non-deductible contributions, you must use Form 8606 to track basis and avoid double taxation. State rules may differ from federal treatment, especially in Massachusetts, Pennsylvania, and New Jersey, so maintain state-level basis records. Roth conversions can simplify future taxes, but are not required. Finally, keep permanent records, including your tax returns, 8,606 forms, statements, and transcripts. As a final note, this content is for educational purposes only and does not constitute tax, legal, or investment advice. Consult a qualified professional regarding your specific circumstances. Tax laws and state rules can change, so always verify current guidance. In summary, determine whether you ever made non-deductible contributions. If you did, locate or reconstruct your Form 8606 and keep the cumulative basis current. If you did not, stop over-tracking account origins and instead focus on asset allocation, fees, and continued savings. Review your state's rules and consider Roth conversions when they make sense for your bracket and long-term plan. Thanks for watching. If this video helped you reduce paperwork anxiety and focus on what truly matters for retirement, please like, share, and subscribe. I would love to hear about your experiences with Form 8606 or your state's rules in the comments. See you in the next one.